Good evening. Welcome to the loan officer training with the mortgage calculator. Today we're going to be talking about income conditions. We've been talking about borrower conditions and property conditions. Today we're going to be talking about income conditions. We'll wait just a moment here to get started. Let us go live on all the different platforms. Thank you to everyone tuning in on all the different platforms. We do stream this on Facebook, YouTube, LinkedIn, Spotify, Apple Music, pretty much everywhere. So we appreciate everybody tuning in across all the platforms. And we'll give everybody a chance to jump on here. We put the chat up on the screen, so feel free to drop a comment there in the chat as you tune in. I see there were already some people dropping comments there nice and early. Appreciate that. And you can also feel free to drop any questions that you have as we go through the presentation here today. So it looks like we're live on all the different platforms, so we can go ahead and get started. We'll take the chat off the screen, but keep dropping comments there, drop questions there, and we will go ahead and get into it. So we'll go ahead and take the chat off the screen and get it started. All right. Welcome, everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a correspondent lender that specializes in non-QM loans. And what we do every Tuesday and Wednesday evening at 7 p.m. Eastern is this loan officer training series. For the past few trainings, we've been talking about property conditions, borrower conditions, and today we're going to be talking about income conditions. So our sales manager, Jose, with 28 years of experience as both a loan officer and a realtor, is going to do a presentation here so we can go through income conditions and learn some more about common conditions and how to resolve them. So go ahead and take it away, Jose.
All right. This is one you do not want to miss for sure. So hopefully we have a lot of the team out there, and also hopefully we have a good audience out there that is going to appreciate the value that we are adding with this presentation on income related conditions, right? I mean, we went over property conditions, right? That's really about the property. You got, if you don't have a property, it's hard to pre-underwrite that one, right? We went over title investing conditions, but income conditions, right? This is the one that is part of the pre-approval, whether the borrower, whether this is a TBD pre-approval or they already have a property, or this is a refi, whatever it may be. Income is key to all of these loans, unless you're doing a DSCR loan, but then you still have income. You just don't have income from the borrower. That's a different kind of income for a different show. So today we're going to get down into breaking down some of the different categories, and we're going to be then highlighting some of the issues that come up in your that can come up in your loan approvals, because what we're trying to do here is trying to be proactive so that you do not end up with all of these types of conditions. So we're going to let you know what you have to request and what conditions you may receive, and how you can resolve them. Good to know this stuff up front, because when you are interviewing your borrower, you definitely want to know what to ask for. So again, underwriting the income begins with the pre-approval. You have to have a thorough analysis of the scenario and all provided documentations and information. So for an accurate income analysis, you need to pay special attention to the following. This is just setting up the scenario, knowing which flow you're going to take, right? You're in your little flow chart. So first you're going to look at what type of income do we have? What type of person? Is this person salaried and hourly, right? Salaried or hourly? very similar, just the hourly is going to be based on the number of hours, but they're both not self-employed, right? So you're going to request, and these are W-2 employees usually, if they are salaried or hourly, because 1099 would be self-employed. So you're going to request from the borrower the last 2 years W-2s, the last 30 days worth of pay stubs, and the last 2 years worth of tax returns. Now, please note the following. Automated underwriting, AUS, may not require tax returns, right? If your borrower does not have any income from rental real estate or self-employment or dividends or capital gains or any other item like that would have to be documented by the tax return. If you're simply going with their W-2 income because they're an employee, there's a good chance that AUS will return findings that you do not need tax returns. So if tax returns are not available, you may still be able to submit your agency loan if you have AUS findings that state all you need are, for example, a common one would be 1 year's W-2s and last 30 days pay stubs for a borrower with good credit. And if it's a little bit riskier deal, AUS may decide to ask you for 2 years. And there's a number of factors that are going to come into play in AUS on what you're going to be requested, and which has to do with the risk in the loan, right? Credit score, LTV, how long they've been on the job, number of jobs they may have had, also in the last 2-3 years. That's, more jobs means more risk. So, depending on those components, I think I mentioned credit score as well. Depending on those components, then the algorithm's gonna spit out some findings, and it's gonna be either the 1 year finding or the 2 year finding for the W-2 employee, right? So again, know what category they're in, know what to ask for. Now, if your borrower has variable income as well, I put variable income because it encompasses a number of income components like overtime, bonuses, tips, and commissions. Um, that will require a 2 year VOE, as you will need an average. Now, you're not going to get the VOE from the borrower, obviously, that's from the employer, but just letting you know what you will need to properly calculate that variable income. Now, you can estimate it by asking the borrower for the last 2 years year-end pay stubs. Maybe they got that December 31st pay stub, and it breaks down bonuses, commissions, tips, overtime, all that kind of stuff on that document, so that you can have a more accurate depiction of the variable income. Please, and this goes for any time you're going to average anything with income, do not average declining numbers, because you're going to get an incorrect number. What I mean by that is, if your 2021 is $10,000 and your 2022 is $5,000, you can't average 15,000 and get 7,500. You have to use the lower figure, which is 5,000. And then obviously your year to date has to fall in line with at least meeting that 5,000 annual figure to be able to be considered, because if not, they're going to go with whichever is the lowest. So if the year to date is lower than the average, they're going to go with the year to date calculation. Most of the time, I see the MLOs going with just the year to date calculation without verifying if there's actually a history of receiving the overtime. Because if it's agency, go to the selling guide, is going to tell you what you need. You need a 2 year history. 1 year may be acceptable. If there's a strong VOE from the employer that states that its continuance is going to be likely, and you have the pay stubs showing that it's happening, and you have the prior year, then you're going to be in good shape. But understand how that works, because a lot of times that overtime is a big number, and if it's not applicable, you could have an income discrepancy. So, right. So let's go on to self-employed. So again, request the last 2 years W-2s, last 30 days worth of pay stubs, and the last 2 years tax returns. Again, disclaimer on AUS may not require them. And the reason I say that is if you have an agency loan where you have a borrower with no properties, no capital gains, no interest income, or any of that kind of stuff that you need, all you're really going to be using is your W-2 income, and they don't have their tax returns, can't find it, didn't file it, whatever it may be, then see what AUS tells you, DU or LP, and take it from there. Non-QM is going to be required. Non-QM is not AUS, so they're gonna, you look at the guidelines, and they're going to ask you for the tax returns as well. Self-employed borrowers, you definitely then want to request the last 2 years W-2s, last 30 days worth of pay stubs, and I write there as applicable, because either this person could be have a job, salary job plus self-employed, or they could be self-employed where they are paying themselves from their company, and they receive a W-2 and they receive pay stubs. That's fine and dandy, but they are not an employee of themselves. They're not a W-2 employee. You cannot submit that loan as a W-2 only file, because they are, if they're 25% or greater, if they have a 25% or greater stake or interest in the business that employs them, 25% or more, they are considered self-employed. Now, that what we're talking about there is for S corporations, right? If it's a C corp, an actual corporation, it's a different story. They are only considered self-employed if they own 100% of the business. And I'll get into that one in a minute, but that's definitely one of the battles that we come up with every now and then. Nick and I have fought that battle a few times, the C Corp battle, and we have won that battle too. So let's get into the actual conditions here now. Some of these are pretty basic, right? So in cases, you can get where the underwriter will, because you haven't provided any of the entity docs, they don't know what the percentage of ownership is in the business. Maybe they're saying that your borrower is self-employed or not, like the scenario that I was just describing to you. So there's a couple of things you can do here. On the easy route, if it's an S corp or an LLC or something like that, usually the ownership percentage can be found in the operating agreement. That is why it's so critical, if you do have a self-employed borrower, to obtain all the entity documents up front with the application. You can't be submitting loan files without articles of incorporation, without an operating agreement, without articles of formation, because depending on the type of loan that you have, what if you have a DSCR loan or a non-QM loan that says that every borrower that's 20% or more owner of the business has to be on the loan? What do you do then? Now you got to bring in potentially 2 or 3 additional borrowers, which then would entail you having to review the guidelines for all the different options out there to send it to the one that may only require a majority owner. Like we have that option where if a majority owner signs, that's all you need. Doesn't matter if you have 2 or 3 other owners that own 15%, or maybe 2 owners that each own 20, 4% and one guy owns 52% and he's the only one that's on the loan, that's fine for at least I know one of our options, our loan options, that's acceptable. But if you pick the wrong one, then you have a condition that is going to make you very busy or going to make you cancel that submission there and submit somewhere else. So, and in terms of, and I'm going to talk in this one about the C Corp, because I'm not sure I put that one as a separate bullet point. But if you do have a borrower who is an employee of a corporation and they happen to have ownership in some of the stock of the company so that they get royalties from that company due to the stocks that they have, unless they own 100% of the stock, then they're not considered an owner of the company, which means that you don't have to take into consideration the losses, nor, unfortunately, can you use the income. But normally it's more like losses that come into play for the corporations. They tend to have a lot of write-offs, a lot of paper losses. Um, so it is a tricky situation because usually how they're going to want you to prove the ownership is by providing the 1120, which is the corporate tax return, so that they can see the breakdown of the ownership in there. Now, sometimes they may get a Schedule K1 that also may break down percentages. So just keep an eye out because that does happen. Now, there is one conduit that we have out there in non-QM that we've dealt with in the past that does treat the C corps the same as the S corps. They can do that, but in the agency world and in most of the other non-QM conduits out there, the S corp and the C corp are treated differently. And that's a very important one because in the last 3 years, I've run into that one about 3 or 4 times already. So next bullet point, need to verify how long the business has been open, has been in existence. Now, this can be tricky if your borrower just formed the LLC. Like I have one right now, my borrower formed the LLC only 18 months ago, but he's been in business 20 years. So the articles of formation or incorporation may help you if your borrower's been in business for at least the 2 years that they require. But otherwise, a letter from an accountant, CPA, or tax preparer will satisfy this need. Hopefully, your borrower's not like my recent borrower that self-prepares their taxes, doesn't have a tax preparer. And also business licenses, if they are licensed. I put licenses because you may have to show multiple years. Like, here's my license for 2021. Here's my license for 2022. And here's my license for 2023. So right there, we're showing more than 2 years in existence. And that's a third party document that's easily verifiable. Same with the accountant, CPA, or tax preparer. You have to verify their information. The CPA, accountant, their license, the tax preparer, their PTIN number, or PTIN, because actually that's the N in PTIN is the number. Verification of the tax returns when we are using tax returns. We touched base on this yesterday, but borrowers and in the disclosure packages, we always send the borrowers a 4506-C. However, it's a wet sign document in the disclosures, and seldom do the borrowers wet sign that and return. But that's okay because you can go and send the borrower a 4506-C that they can sign electronically. Now we have that new form available. You just got to click on it, that this is going to be an electronic signature, right? Fill it out with all the correct information, send it to the borrower via whatever e-sign program that you have, and then submit it. We use CIC. You can submit it through there, through the vendor. And it'll take however long it takes. You have to see what the turnaround time is on that. It usually could be a week, 2 weeks, depending on what time of the year. Or you can have the borrower go directly to irs.gov, make sure that they set up their account, and then they can obtain the needed document, and just make sure that the URL appears in the bottom of the screen. Now, if it's a full doc loan, you're going to have to obtain the record of account tax transcript. That's the one you would order from through the vendor that we have, or that's the one that you would request the borrower to obtain from irs.gov. If it's an alt doc loan, then depending on what it is, they're probably going to require you to do the W-2 and 1099 transcript, right? So that's one of the conditions they ask you for, obviously, 1099 loans, right? Variable income verification. Now, we talked about, right, in the previous page, what variable income is, right? Overtime, bonuses, tips, commissions. So I touch base on this briefly, which typically we're going to require verifying with the 2-year average that is obtained by requesting a written verification of employment from the employer and the prior employer if the borrower is in their current job less than 2 years. I did mention the 1-year history may work if the year to date shows variable income and the employer states that it is likely to continue. So if they got the overtime on the VOE and on the pay stub, and the employer checks that one box on the VOE that states is it likely to continue? Yes. And then maybe on box 20 in the VOE, they can write some additional remarks, regarding that kind of stuff. Great. Then you will probably get the underwriter to accept the 1 year plus the year to date without having the full 2 years. Again, remember about averaging, right? You can't average declining values. Verification of self-employment, again, is pretty basic unless your borrower doesn't have a tax preparer. This is very easy with just a letter or the license or entity docs. Now, what type of scenarios are we talking about that this could occur where it could stump you? A handyman, right? Handyman doesn't have a license. He's a sole proprietor, doesn't have articles, entity docs of any type, but hopefully he has a tax preparer or an accountant or a CPA, because the handyman can be self-employed. The guy that just whatever odd, weird kind of job that they do, that's okay as long as you can get the accountant to put it on a piece of paper in a form of a business narrative. There is different forms for really depends on which conduit we are using for the loan submission, right? So be aware that some do have specific business narrative letters or just specific information that the letter needs to contain. So let's talk about income discrepancy conditions, right? Because this is the one that most people get. First page is a little bit easier, but this is the one where you get. And I want to tell you some of the reasons why you get it, and then I'm going to tell you the right way to do it. If you're getting an income condition on a salaried or hourly borrower, that is probably because you just took the number of hours per week, multiplied it times the hourly pay, and that's your income, right? But unfortunately, you may be lucky. I actually had one the other day when we did it the right way. They were only off by like $25, $30 a month. So that was a borrower that didn't miss any work, didn't have any paid time off, didn't have any sick days, didn't have any vacation days, wasn't late to work, didn't leave early to go to the doctor. You know what I mean, Nick, right? Oh, and didn't have a pay raise in the middle of the year, right? Because what if he was getting paid less, and now you're looking at, oh yeah, he gets paid $25 an hour times 40 hours, whatever that is, but maybe he started at $20 an hour, right? So you're going to be off. Now you could get around that one with a letter of explanation from HR or on the VOE, where it's going to state the borrower received a raise on June 18th from $20 to $25 an hour, and then they're going to adjust the year to date calculations based on that. But you're not going to know that unless you go a little bit deeper, right? So if you do get that kind of condition, then it's because unfortunately you took the easy and the incorrect path. What you're supposed to do to properly calculate the salaried or hourly income is obtain the year-to-date pay stub, review what pay period it is through to determine the number of months passed. And what I mean by that is, if the pay period says, okay, November 5th, I'm going to go weird on this one, right? November 5th through November 19th, right? So that'll be a bi-weekly person, right? But you're like, wow, that's really weird. How do I figure that out? Well, it's easy. You got 19 days that have passed in November, and November has 30 days. So you get 19 divided by 30. That gives you 0.63333 repeating, right? So you have had 10.6333 months that have passed in that scenario. So you would divide your year-to-date income, whatever it may be, by 10.6333. Now, what you have to take into consideration here is keep an eye on paid time off, vacation days, sick days, and there's some other weird categories, like when you're dealing with a nurse, the night shift, the weekend shift, and all they, I mean, these nurses have like 15 categories in their pay stubs. But on the easy ones, like the paid time off, the vacation days, sick days, find out from the borrower the vacation, did they actually take that time off, or did they cash in the time and still worked it? Because what you're supposed to do, once you determine, okay, the paid time off was paid time off, the vacation was vacation, and the sick days were actually sick days, because sick days and vacation days can be cashed in. If you have a lot of them, and your employer says, hey, you got like 2 months there in vacation and like 180 days in sick days, you're not going to use all of those, and you can cash them in and not actually have missed those days. Because what you're supposed to do, if you determine those days were not worked, that number, you have to add it to the year to date to get a proper number, because those figures will be calculating the hours that they didn't work and then paying them those hours. So you're going to have less hours in the year, and so that they actually worked. So you have to add the time they actually worked, plus the paid time off, plus the vacation days, plus the sick days. Once you've determined that they actually did not work those hours, get that sum, that figure. Let's assume it's like I have there that the total of everything is 19,870, and they worked 7.6 months. And so your income is 2614.47, right? So again, you get the pay stub, you have to ask questions for the borrower. And also, now that we're talking about pay stubs, be on the lookout for loans, undisclosed liabilities that are getting debited, or other items like child support, alimony, and other things that appear on pay stubs that are undisclosed, could be an undisclosed liability. Those do come up. And I mean, as child support can be a substantial amount, $1,000, $2,000 a month. And if it's getting automatically debited from their pay stub, you're not taking into consideration, and the borrower didn't disclose it because they're hoping, like, how are they going to find out? Oh, fraud guard finds out if you're divorced. if you've been married and you're divorced, and then you're going to have to backtrack and figure it all out. So keep an eye out very closely to the pay stub. Everything on there. The pay stub is not just look at the 40 hours, look at the $25, and that's it. No, there's a whole bunch of information on there that you have to be aware of. That in itself results in conditions when you don't look at the pay stub. Underwriter does, and they condition you for something that you should have looked at. So how do you avoid it? Bring out the magnifying glass, take a good look at it, make sure you don't miss anything. Self-employed borrower income discrepancy. Yeah, usually these happen because the MLO did not properly complete the income worksheet. I mean, I've seen MLOs extracting income for an 1120S owner just from the 1040. They're looking at the K1, they're trying to figure out the income there, and that'll give you somewhat of a picture of the income. But then you're going to be shortchanging the borrower potentially hundreds of thousands of dollars, it could be, because you're not going to be able to add anything back unless you are looking at their corporate tax returns if it is applicable, right? Because your self-employed borrower is gonna have, either they're going to be a sole proprietor, which means they're going to be filing their income on a Schedule C. They're going to be involved in some type of a partnership, which means they're going to be filing a 1065. They could be 25% or more owner in an S Corp, 1120S, or they could have the corporate tax return. They could be owner of the corporation, or not own a corporation, but own 100% of the stock of the corporation, in which case the 1120 would come into play. You have to complete the income worksheet properly, right? If they do have these other entities involved, gather all of the documents. You cannot accurately calculate a self-employed borrower who has an S Corp without the 1120Ss, specifically the last 2 years. Same with all of these reports. Please get the information. A year-to-date profit and loss may be needed, and the 2 years may be needed. Now, again, let me back up a second here. You're going to be doing, if you have an agency loan, conventional, right? I would suggest that you gather all the documents, but then on your conventional loan, calculate the 1 year most current year income first, assuming obviously that it's higher. If you have declining income between 2021 and 2022, you're going to have to use the 2022 income. If your decline is more than 20% from 2021 to 2022, that P&L for 2023 better be strong, because you're going to have to be doing some explaining. The borrower's going to have to be doing some explaining as to what happened in 2022 that resulted in a more than a 20% decline, because they want to make sure that it's not a sinking ship. So again, getting back to setting up 1 year income, because then you're going to run it through automated underwriting. This is for conventional loans only, by the way, only conventional loans. You're going to run it through automated underwriting with that 1 year income, which hopefully is going to be better because you had a lower 2021, a higher 2022. You're going to use the 2022, set it up, submit it through automated underwriting, and cross your fingers and hope you get the 1 year finding. And usually you do. If your borrower has 700 or greater credit score and they've been in business for 5 years or more, you're going to get it through Fannie and through Freddie. LP, either way, let me give you another suggestion. Self-employed borrowers usually should go LP and not DU, because LP, the Form 91, is much more flexible on borrowers when they are not withdrawing the money from the business through distributions, but just claiming it as income, right? Fannie Mae says that if your distributions are lower than your ordinary income, you got to go with the lower amount, the distributions. Freddie Mac says on the same scenario, I'm going to use this $100,000 ordinary income, $20,000 distributions, right? And this is on the Schedule K, right? You're going to see this. If it was a Fannie loan, your income is $20,000. That's it. If it's a Freddie loan, LP, and the business has liquidity, then your income is 100,000. Obviously, assuming your adjustment, but the income you can use then to put in the worksheet to keep calculating all the other components, you'll be able to input that $100,000 figure as the income that you're going to put in the worksheet to start deducting and adding instead of the $20,000 for Fannie Mae. So there should really be no reason to use Fannie unless you didn't get a Freddie approval and unless you know you don't have an issue with distributions versus ordinary income. Don't get surprised with the condition from underwriting when they tell you that your income is 20% of what you thought it was and they tell you that reason and you're like, oh my God, I had no idea. Well, now you know. That's super important to know. And what's also important to know when you're calculating this income worksheet is all of the components that you can add back, right? If it's the Schedule C, look at the mileage on page 2. See if the borrower actually detailed the business miles on that. Sometimes it's on that form, and sometimes it's, I believe, 4562, I believe, is the depreciation form, where they may put it in there, and then that's where they'll have their mileage and all that kind of stuff. So you gotta check around, poke around, and look for the miles. That's an add back. Same as depreciation, same as depletion, same as amortization. However, keep in mind, depletion is depletion. Has to say depletion. Amortization has to say amortization, and the amortization we're talking about is not amortization of the loan. It's business startup expense is what they call amortization. So if that's on there, awesome. If it's not on there, and then look for the other components like meals, right? Meals is a deduction for whatever they deducted. You got to add it in there, and it's going to be deducted from the income. So please properly complete the income worksheet, all the components. Make sure you're putting it in the right sections as well, right? There's an 1120S section, there's an 1120 section, there's a 1065 section, there's a W-2 section, which is your W-2 income that you paid yourself from your business, not separate W-2. So sometimes people mess that up, right? Don't do that. And let's talk a little bit about rental income. Now, rental income discrepancies are very common as well because MLOs grab the lease and they assume, he says his lease is $2,500, so they put $2,500 on the income. That's the first mistake that they've done. And then they get the other components and they make mistakes, like, for example, adding back when you're calculating, when you're completing the Schedule E income calculator. By the way, the Freddie form is the Form 92. I don't recall the Fannie form if it has a specific number, but the Freddie is the Form 92 is Schedule E. Form 91 is the income, the self-employed. So you have to pay special attention to if they're actually escrowing for taxes and insurance. That's one of the biggest mistakes that I see people make. Why? Because on the form, it shows mortgage interest added back, right? Property taxes, right? It says there, grab line, whatever it is, property taxes, put it in there, and it shows a plus because you added back, and insurance added back. So people are like, hey, it asked me for it, I put it in there. Yeah. But you only put it in there if they're escrowing for it, because we're not going to double charge them. That's the reason why we put mortgage interest in there, right? Because we're already calculating the P&I, principal and interest payment, in their DTI. That's already taken into consideration, as is taxes and insurance if they are escrowing for it. So that's why you got to ask for those mortgage statements on these full doc loans of all the real estate they own, so that you can see if they're actually escrowing, and then you can either add it back or don't add it back and keep it as an expense, right? Obviously, depreciation is an easy one you're going to add back, but another one that could help you is non-recurring expenses. The same rationale as a non-recurring loss or non-recurring income is a non-recurring expense, right? And what am I talking about specifically? Large capital investments in the property, like roof replacement. Had to replace the drainage pipes because they were corroded, as could happen to galvanized pipes, and you had to spend $25,000 to redo that, or $20,000 to redo the roof, or any large expenses like that aren't part of regular upkeep. Painting, I don't think that is going to be something like that, but like replacement of the windows, that's not something you do every 2 or 3 years. You replace windows every 20 or 25 years, and that's it. The roof the same, the other component the same, redo the electrical system the same. Had to spend $8,000, $10,000 on a new AC system. That's every 15 years. So things like that are non-recurring expenses that if you can document them properly with the contract, with the proof of payment, with a letter of explanation, all of those components come into play, then they will allow you to add that expense back. And that's pretty substantial. That can really help your deal when you're properly calculating the rental income. If you have a property that was just put into service, right, that was previously owned, that's going to be a tricky one. You may have to document that, who was living there. My mother was living there. My mother unfortunately just passed away. So now I'm renting that property out and I just put it into service. Okay, that's probably one, if that's pretty morbid, but show the death certificate and the other items, and that could be something that would be acceptable. But if you owned it and you just didn't claim it on your tax returns, and now all of a sudden, because you need the money, you're going to put it on there, you're out of gas. That's not going to work. If they just bought the property, right, during the current calendar year, that's an easy one. Provide the lease, provide the proof of purchase, closing statement, the lease, proof of receipt of the last 3 months payments, and you're good to go. They're going to let you use that income. So, and those three income discrepancy components, I gave you guys a lot of good nuggets of knowledge there. So everyone who's looking at this show tonight, you're definitely going to elevate your income analysis. Confirm year-to-date income for self-employed borrower. It's pretty easy with a year-to-date unaudited profit and loss report from a tax preparer, accountant, CPA, and provide their license or PTIN verification. Please look at these P&Ls before you turn them in. Make sure they're correct. If you have a declining income, you're going to have to provide explanation for the declining income, because they may actually then downgrade your income to match the P&L. However, they're not going to allow you to use the P&L to increase the income. It's a subjective situation, but that's just the way it is. Capital gains and dividend interest income. Make sure you really need it, right? Because this is one that is not easy to confirm, because you have to show a track record, normally at least 3 years that they've received it, and that it's going to continue. And the going to continue part, they like to know it's going to continue for at least 3 years as well. So that may be tough if it's stock sales, right? Capital gains from some stock sales. So you know how that goes. However, if it's a non-recurring loss from some kind of a capital sale, like I sold a property and I lost $180,000, I don't sell properties every day, then that non-recurring loss may be able to not be considered. This is very important also for self-employed borrowers, where on their statement of income, whether it be the Schedule C or whether it be the 1120S, there's going to be a section there for non-recurring loss or non-recurring income. I've had them, and the non-recurring losses, and normally it's a paper loss, because normally they had a big hit 4, 5, 6 years ago. They're allowed to spread it out over time, and that's what they're doing. And if that's the case, and that doesn't really depict their current economic situation of the business, the current economic health of the business, with a nice strong letter from the tax preparer, accountant, or CPA, and maybe some additional documentation, you can usually get that item removed. And that's really going to help you out. So, covered quite a few components here of income. Sure, we could go forever, because we have all sorts of weird conditions, but I think that we covered most of the major income conditions that anyone's going to get. And I'm surprised we don't have any questions. Am I doing such a great detailed job in explaining it?
You're just that good, Jose.
Yeah, okay, man.
Absolutely.
They're just sitting there listening. Oh, yeah, writing it down. Well, this is recorded, folks, so you can always watch the episode and use it as a very good reference.
Yeah, absolutely. Yeah, wait just a second, but I don't see any of them coming in, but definitely something you could come back and watch when you run into some of these issues as well. So we'll go ahead and wrap it up then. Remember, 7 p.m. Eastern Time, Tuesday and Wednesdays is when we do these loan officer trainings. We appreciate everybody tuning in. Thank you, Jose. Great presentation. We'll see you all next week, Tuesday and Wednesday, 7 p.m. Eastern, for the next episodes of the Loan Officer Training Series with the Mortgage Calculator. Have a great night, everyone.
Thank you, everybody.